Good morning and welcome, everyone. I'm Johnwei Muljono, the president of Ohio State University Alumni Association for Indonesia. I will be your host and your moderator today, along with Georgina Atkinson, manager, Knight Frank, Asia Pacific, based in Singapore. Today, we have fantastic talk. Legacy planning, investing into US real estate for the future generations. A collaboration of Indo-Buckeyes, Knight Frank, Asia Pacific, and Douglas Elliman of US. We have assembled a fantastic panelist for you today. We have Frank Jiang, Managing Director of Premier Fiduciary. Frank will be talking about investment, its structure, tax implications, and perhaps also immigrations. Then we have Andrew Wachtfogel, Head of Research, Douglas Elliman. He will be talking about data-driven research. And also we have Richard Jordan, Head of Global Markets. Richard will be sharing his perspective on the market and commercials. Yes, we are all excited to go ahead to share this talk with all of you. Before I do that, I would love to call upon Victoria Garrett to say a few words. Victoria is the head of Knight Frank Asia Pacific, based in Singapore. I would love to welcome Victoria to say a few words and introduce Knight Frank Asia Pacific Residential to all of you. Please, Victoria.
Thank you very much, Pak John. It is such a pleasure to be with you and everyone here this morning. As you said, I'm head of residential for Asia Pacific, based in Singapore, where we're headquartered regionally. And I'm part of Knight Frank, where I've worked for the last 10 years. Knight Frank is the world's largest privately owned property consultancy, which is headquartered in London. And we have over 500 offices in 60 territories and over 19,000 as part of our team globally. We operate in locations where our clients need us to be and provide a worldwide service that is locally expert and globally connected. So we are best placed to be people's partners in property. In 2014, Douglas Elliman and Knight Frank formed our strategic alliance. And in the US alone, we have a staggering portfolio of over 75 billion US dollars, covering new development and secondary market properties. And our coverage spans the markets of New York, LA, Miami, Aspen, Boston, and more recently, Houston. There has long been a strong affinity between the US and Indonesia, and it's really great to share with you our insights of what is happening on the ground today and the opportunities that we see, with the time being now to invest, especially with the election in the US shortly upon us. So I will now hand over to your co-host for today, Georgina Atkinson, who heads up the Douglas Elliman relationship, Knight Frank relationship in Asia Pacific. Over to you, Georgina.
Thank you very much, Victoria, and good morning, everyone. It's a pleasure for you to join us today, particularly on your Saturday morning. We really appreciate it. Pak John, it's an absolute pleasure to be co-hosting this panel discussion with you and to have been working with you over recent weeks. You have been incredibly supportive to both myself and the Douglas Elliman Knight Frank team, and we're truly appreciative of your time and continued support and efforts. We look forward to working closely together and, of course, to hopefully seeing you in person in the not too distant future. Before moving on, I would also like to thank my colleagues at Knight Frank Indonesia, who, working alongside Pak John, have kindly organised and coordinated this event today. Wilson Calip, head of Knight Frank Indonesia, has been an incredible support of our US residential business. Prior to the pandemic, I was lucky enough to spend some time in Jakarta with Wilson and our Knight Frank team. And when travel allows, I'm really looking forward to returning. Pak Wilson and Martin, I wanted to thank you again for your kind support and continued collaboration. So, moving on. As expected, current economic conditions have only increased market volatility in the short term. Our investors are being inspired to place a much greater emphasis on stable assets, assets which offer future income stability and long-term price appreciation. Of our clients based in Asia, I have personally seen a considerable uptick in recent weeks in respect of capital flow from Asia to the US. Thank you to all of those who have shared questions for our panel today. We will try to answer these all in the time that we have, If not, you're more than welcome to email us, and we will answer those within the next 24 hours. With that in mind, it is a great pleasure to introduce my colleagues and our speakers today, starting with, thank you, Pat John, for touching upon this, Frank Jiang, Managing Director of Premier Fiduciary, our trusted partner in respect of corporate structuring. With offices in China, Singapore, and Hong Kong, Frank is a leading advisor to not only our private clients, but banking and family office clients across the globe. Frank is a qualified lawyer and a true expert in his field. He is an incredible resource to our business. We will then move on to hear from Richard Jordan, head of our Global Markets division. Richard travels internationally and advises many of our brokers, clients, and discerning buyers on emerging market trends in our new development portfolio. Following Richard, you will then hear from Andrew Wachtfogel, head of research for Douglas Elliman. Andrew is absolutely instrumental in pricing our new developments. He represents the company's market-leading research team, not only to our developer clients, but also to construction lenders, equity, and institutional investors. So before I hand over to Frank, I am going to introduce a poll question, which should pop up onto your screen now. So, what are the main reasons either you or your clients are seeking to buy property in the US? This is a multiple choice question, and please do answer as many that you feel relevant to yourself. Thank you. So without further ado, Frank, I will hand over to you to begin today's presentation. Thank you as always for joining us.
Okay, thank you so much, Georgina. I'm just going to share this screen, and then we can go ahead and start. Okay, maybe just some brief background about myself. I'm a US lawyer by training. I went to UC Berkeley for law school, qualified in California. And today what I'm going to do is I'm essentially going to be talking about the drivers for real estate purchasers by foreign nationals, specifically Indonesians. Okay, so what we do is we manage thousands of structures, mostly for Asian clients, and many of these structures are investing into US residential real estate. Okay, probably the most common question that I get is actually, you know, how do I make sure I purchase real estate, okay, but I don't get caught in the US property or the US tax net of the global income tax? So today, basically, I'm going to be talking about that. I'll be talking about the current status of the immigration and how to structure those assets, as well as various family office solutions for residency. So this is what we saw in 2009 and 2017, okay, is that, you know, after 2009, because of the financial crisis, there was a huge flight to safety. Safety meaning US dollar assets, because a lot of Indonesians are very familiar with what happened with the Asian financial crisis, where the rupiah dropped so dramatically. So they're very comfortable with US dollar assets. Number two, safety, meaning that, and we'll talk about this, but basically they want, you know, safety for their family, their kids. They want a safe place to go to. They want that kind of safety. The second thing we saw basically after 2017 was basically a flight for value. And so, you know, what ended up happening was that, you know, and after 2017 in Indonesia, they had the Common Reporting Standards, the CRS. So anyone in private banking will be familiar with the CRS and FATCA. And one of the main advantages of the United States is that any bank account or any property in the United States is not subject to FATCA or CRS. So there's a large interest in U.S. real estate and U.S. assets because of that. Okay, and probably the biggest reason, frankly, of any reason to buy in the United States, we've seen from what we've managed, is personal connections. You know, they have kids working in New York, kids working in Los Angeles. You know, their kids are going to school there. And they're worried about, you know, their safety. And so this is probably the biggest single reason we see a lot of people buying US real estate. The other driver that we see of foreign nationals, Indonesians, is, you know, when I go to the United States, how do I make sure my kids are not becoming US persons for tax purposes? Because my kids might be coming back to Indonesia and I don't want them to be caught in the US person tax net. Okay, so that's another issue that we always see, is making sure that the kids do not become U.S. persons when they go to the United States or when they buy U.S. property. So as a result, what we see a lot of recently is in Singapore. I'm not sure if anyone is completely familiar with this, but it's a huge deal in the last 3 years as a result of the tax amnesty that's ending in December 2020. Is this 13X, 13R Singapore structures, and we'll talk about that. The family offices. Obtaining residency, a lot of Indonesian clients, they want to obtain tax residency outside of Indonesia, primarily because that the tax amnesty is ending, but they don't want to basically become tax residents in the United States. So we get a lot of these issues where it's not just US person or non-US person, it's also sort of their tax residency of Indonesians. And then probably the main thing that we see a lot of in relation to just tax is a lot of questions in relation to the $60,000 US estate duty exemption. This is a huge deal, okay, that I really want to emphasize is that, if you're an Indonesian non-US person and you want to buy a piece of real estate in the United States, you really need to consider at least putting it in a structure, especially if it's a high value asset, primarily because if you buy it for $1 million or $10 million in cash and you get hit by a bus the next day, you're going to lose about half the value of that literally the next day, because the US tax IRS considers that a US situs asset. And as a result of that, it goes through US estate duty, and the United States has only got a $60,000 exemption on that. But the good news is that it's super easy to basically structure that out by what they refer to as a foreign blocker, which is a foreign company owning a domestic LLC. And because companies don't die, you're never subject to US estate duty. The third reason we see a lot of people going to the US real estate now is primarily because of the stamp duty, because a lot of Indonesians will compare, Singapore stamp duty, ABSD on purchases, Hong Kong stamp duty, UK stamp duty, and then they look at the United States, a big major city like Los Angeles and New York and Boston, where their kids are actually going to study, and they think it's a great value primarily because of that, and it's a US dollar asset, which Indonesians are super, super familiar with, okay? And I guess what I had alluded to earlier is that we saw a massive flow of clients moving money to the United States under US trusts, primarily because US property and US bank accounts are not subject to FATCA or CRS. And for any high net worth families who need to think about structuring, these are actually probably the major considerations besides residency, okay? So let's just give a brief update, because everyone's probably worried about how are my kids going to go to the United States to study, okay? Most Indonesians are not applying under the ESTA, which is the electronic application. Japanese, Korean, they can actually go ahead and go in under that. They only allow 30 to 180 days, but you're a non-US person, so you never have to worry about US tax, okay, as a US person, global tax. If you're visiting under B1, B2, the same thing. So this is the one that will apply to Indonesians, is that you're still a non-US person. You can buy the real estate, you're in there under B1, B2. You never have to worry about US estate duty, okay, of global income tax. You never have to worry about that, okay? The F1 student visa is probably the most commonly misunderstood one. If your kids are going to the United States, and obviously there's a lot of Big Ten Buckeyes there. I went to Notre Dame undergrad, okay, so I'm very familiar with this, is that the F1 student visa, you will never be a US person. Not only that, while you're studying there, you are allowed 1 to 3 years. If you're in the STEM category of engineering or sciences, you can get a 3-year work visa when you graduate, and you are also not considered a US person. So I get this question a lot, primarily because a lot of parents who are wealthy, they may send their kids to the United States, and now they're worried about putting them in their trust or their will or other things in Singapore or Hong Kong or elsewhere. And I guess I'm just trying to tell you that that makes no difference as far as US tax is concerned. They are still considered non-US persons under an F1, and even 1 to 3 years after they work, okay? These two, the L1 intercompany transfer and the J1 interns, right now, they're frozen, okay? F1 is a big issue right now because some countries have not even opened the embassy to apply for the F1, and the US is now trying to kick out existing students under an F1 that are still sitting in the United States. So if you've been reading your news, the F1, L1, J1, okay, and also the H, yeah, these are actually the biggest ones. H, they also froze that. H is how a lot of medical personnel, they go to the United States, okay? These are all non-US persons, okay? Now I'm going into the category that where you could become a US person. The E2 allows for Singapore, Taiwan, Korea, other countries that has a tax treaty with the United States, okay? That allows you to invest into the United States, but this is not open to Indonesian clients, primarily because there's no tax treaty in place, okay? The most common one for Indonesians who want to become a US person is the EB5, and they recently jacked that up to 900,000 or 1.8 million if you're investing through a major center. The good news for Indonesians is that it's actually a wide open category, meaning that it's an open lane. So it isn't like if you're from a China passport, you actually have a 15-year wait list, okay? Or India, there's a 3-year wait list, but actually if you're actually from Indonesia, it's open. So if you do want to have a kid that goes to the United States and wants to live there and become a US person, then you can look at possibly EB5, and we can help with all of this. You know, I went to law school. I know I have friends that are working as immigration lawyers. We're very familiar with it, but at some point you're probably going to want an immigration lawyer either on the East Coast or on the West Coast. So we have those connections. But this is just a rough overview of what's going on. But you can see the US is kind of freezing right now with President Trump, the whole F1, L1, J1, H visas. And so you need to be aware that there's definitely a freeze on those. But actually it's okay because you're still a non-US person. You can still go there as a foreign visitor, okay? So that's just a status update. So say you go in and you want to buy a piece of real estate, okay? This is the single most common structure. And I'm telling you, there's probably tens of thousands structures of real estate in New York alone, not including Los Angeles, okay? But the most common way of doing this is actually the foreign owner, the Indonesian, decides that, you know what, I want to buy a piece of real estate, but I know there's only a $60,000 estate duty. You know, how do I structure that so I'm not hit on everything above $60,000 in case something happens to me, okay? The way to do it is actually you set it up through either a Hong Kong company or any foreign entity, and that entity becomes taxed like a foreigner. That entity owns a domestic, what's called a partnership LLC, that then owns the US property. This is the single most common way of owning real estate, either houses or condominiums in the United States, and you can completely avoid any of the global US tax debt, and you can completely avoid any estate duty. It's a wonderful solution, and if you look at the New York Registry of Owners, you will notice that tens of thousands of these, you know, condo units in New York City are actually owned by companies. And that's the reason, because they want to avoid US estate duty, okay? And they still don't want to become a US person, and they kind of want to be, they're fully disclosed, but it's not out in the open, okay? The second case study I'm going to talk about is essentially, say you don't want to be taxed like a foreigner. You just want to go ahead and tax as a local individual, okay? So in this particular situation, you as the Indonesian foreign settler, your kids might be back in Indonesia or in other countries, okay? You can go ahead and set up a US trust, and then that US trust owns the LLC, and then you go ahead and own the US property. The major difference on these two cases is the fact that in case study 2, you're actually taxed at 22% on the capital gains of those particular real estate because you're being taxed like a US person. The advantage of case study 2 is because it's under a US structure, you don't die. Okay, so you're never subject to any estate duty on case study 2. Case study 1, in comparison to case study 2, is that if you sell your property, you will be subject to 30% on the capital gains. Unlike case study 2, which is you're subject as a domestic US person because it's a US trust. Case study 1 is you're taxed like a foreigner, okay, because it's a Hong Kong company acting as the foreigner, all right? Most clients decide to go with case study 1 if they're going to live in it for their kids and they're buying a trophy property and they want something safe for their kids to come back to, and they just want to, you know, have a safe place where everyone can get together. And we see this structure a lot in situations where They just want a safe place for the whole family to come back together on holidays and summer vacations, go shopping at Costco, and we hear a lot of stories about, they go there, they have to mop all the floors and, they have someone do all this cleaning up in the house. But this is the most common structure for that. If, on the other hand, you want to rent out the property and there's real income coming in, then you're probably going to want to look at a case study 2, primarily because you have a lower capital gains tax and you're treated like a US person, and you can write off a lot of the expenses. Okay, so that gives you a rough idea. You can also own it under your personal name. Again, if you're going for big assets, you probably should think about structuring it in a structure, owning the property in a structure. But if, on the other hand, you want to basically, it's a $500,000, $1 million asset, you can just buy it in your own name and essentially, just deal with the taxes in the event something happens. And that is perfectly okay. What we normally deal with is working with wealthy Asian families is that they want something, where essentially it's completely compliant, but maybe their name doesn't show up and someone else just manages all the tax issues. And that's what we do, okay? In both these structures, there's no US estate duty issue. The US estate duty issue only comes up if you own it in your own personal name, okay? All right, this is the area where it's not just like US tax and, when you're structuring as a foreign investor, but because of the Indonesian tax amnesty that came into effect in January, we saw a lot of this issue come up, where a lot of clients said, okay, fine, we're gonna go ahead and follow the tax amnesty, we're gonna pay our tax, let's go ahead and just resolve it, and we won't have to worry about it for 3 years because the tax amnesty doesn't end until, say, December 2020. Well, guess what? We're actually close to December 2020. And so we're getting a lot more queries on, hey, I have a family member that wants to live outside, and we want to set up trusts around him, whether in Singapore or elsewhere. We want to make sure that he gets residency outside. So what we've seen is Indonesians looking at Singapore, Thailand, Hong Kong, and Taiwan, predominantly from Indonesia. I'm going to focus on basically Singapore, but we've resolved, and we've provided solutions for clients in all sorts of jurisdictions. So if you have issues where you want to look at something like that, you can feel free to contact me. But really what I'm going to focus on is because, clients from Indonesia are looking for family offices and so they can get the residency outside, Singapore has actually come up with something quite interesting, which is this 13X, 13R. 13X applies to above 50 million, and 13R applies to basically any amount whatsoever. But you need to spend 200,000 Singapore dollars per year, but you can actually spend it on salary, for example, okay? And so you can actually use this and set up a single family office and employ yourself, okay? The second thing I'm going to talk about that's also related to this is simply setting up what's called the VCC, which is kind of like a Cayman fund, but it's incorporated in Singapore. And so this only got effectuated in February of this year, but there's a huge demand. We've already set up 5 of these structures, since February, and this is during the shutdown of coronavirus. Okay, there seems to be a lot of interest in Singapore, primarily because the clear transparency, the legal framework. It's a major financial center. It's close to Indonesia, so the planes can go back and forth quite easily. They also find Singapore quite safe. So we have a lot of Indian, Indonesian, and Chinese clients. They seem to really gravitate towards Singapore, as opposed to Hong Kong now, which has some issues anyway. Okay, so this is a little bit technical, but I think it's useful for Indonesian clients really looking to structure a family office. Okay, so what ends up happening is that we will normally set up a family trust, or your Indonesian family will himself be the shareholder of a Singapore company, all right? That Singapore company applies for 13R or 13X in Singapore. Again, 13R seems to be immensely more popular because you don't have this $50 million single requirement, okay? But you do need to spend 200,000 Sing per year. We help the client open the private banking account. They leave $5, $10, $20 million in the private banking account. And then this is, okay, so the main thing is basically you need, under a 13X or 13R, in this structure, you need what's called a capital market services license entity, which is regulated by the MAS, okay? So we have a CMS licensed fund manager that can act on this, charging absolutely minimal fees in order to set up your 13X or 13R, okay? You need to have it in this particular structure in order to get a Singapore company with no income tax whatsoever. So Singapore normally has a 17% income tax, but you had 0 income tax under a 13R or 13X. But you need to meet all of these MAS exemptions in order to get that. So the question that I always get is, well, then how do I go ahead and live in Singapore? This is the entity right here. So for every 13R or 13X, there are 2 Singapore companies. One is the entity with the 13R or 13X. There's another entity that's referred to as the single family office, okay? This single family office would act as a sub-advisor to the licensed fund manager. And this single family office basically employs the shareholder or of the family trust or one of the family members sitting over here. And so this becomes the employment entity. This becomes the tax exempt entity. This used to be commonly done with like Cayman companies, BVI companies, Seychelles companies. We continue to do all that, but what I can tell you is that there's greater interest in doing it like this now, okay? So we can do the entire thing from end to end. There is a lawyer that needs to get involved for the filing, but we've done this many times, so we're very familiar with how this looks, okay? Again, what is the whole purpose of this? The purpose actually is so that you don't have tax on your wealth, but you also are employing someone in Singapore and are a tax resident in Singapore so that you are no longer a tax resident in Indonesia, okay? And then you build the wealth around that, okay? And that continues to grow, and that's perfectly compliant. And with that, then you can purchase all the real estate in the United States, and you never have to worry about Indonesian, CFC issues, controlled foreign corporation issues. You don't have to worry about U.S. estate duty issues. You don't have to worry about a lot of these structures under these kinds of structures, okay? So there's another 13X, 13R where you can do the same concept, but you don't need a licensed fund manager, okay? And so essentially it looks like this where they set up a Singapore Family Trust. You still have to meet all the requirements, set up the 13R company, and you set up another SFO, but because there's no licensed fund manager, it all just sits under here. The hallmark difference is that your fees will be a little bit less, okay? But the person who you are employing as under the SFO in this, they must have some background in managing assets because this person is the person who will get the MAS exemption on the 13R because they have to show that they're a professional investor. And so a lot of people who don't want to either live in Singapore or they don't want to mess with this, they go ahead and go with the previous one with a licensed fund manager. This structure is really designed where the family member wants to live in Singapore, they want to go ahead and have some of their experience in fund management, and they want to build out their credentials in Singapore, okay? So again, generally, these are the structures, at least in Singapore. In other countries, they have different things to help them get residency in those particular countries. I find the Singapore model quite interesting because it's a non-tax Singapore entity, and within Asia, that is, Indonesians love Singapore, okay? Because for Indonesia and Singapore, there is a very large connection there. And it's a Singapore company without any income tax, which never used to exist until about 2 to 3 years ago, okay? So I'm not gonna go into details with this, okay? But again, the main difference is that on both, you need to spend $200,000. There's some small differences in terms of what you can and can't do, okay? But basically, you can go for 13R or 13X and 2 Singapore companies if you also want a single family office with an employment and get residency in Singapore, okay? All right, again, okay, so what I'm talking about now is essentially a VCC. This is essentially taking away business. Singapore's move to take away business from Cayman funds and Luxembourg funds, okay? So historically, Cayman funds were the largest jurisdiction. So clients that used to have a fund manager in Singapore or even fund managers in Indonesia, they would commonly set up a Cayman fund. This is Singapore's stab, and I think it's actually a pretty good attempt at making sure that there is no tax under a Singapore fund, okay? So it can do a lot of the same things that the Cayman funds can do. You can issue shares, you can pay dividends, you can get financial statements that are not made available to the public. And so there's a lot of these issues that are a big deal right now, primarily because a lot of the Indonesian families who want to make investments within Asia, they want to do it under fund structures, okay? The VCC, unlike the 13R or 13X family office, you must have a licensed fund manager. We have a licensed fund manager if you need it. We charge absolute minimal rates, but you don't even need to use us. If you have other fund managers, we're very happy just setting up the VCC for you or your family. The advantage is under the VCC, you can still use your BVI if you want to invest. You can invest under individual names. There is no public registry, so no one can see it. We do a lot of structures where it's under a family office, or it could be your 13R company coming in. And we also do a lot of structures where UBS, Credit Suisse, Bank of Singapore, or some insurance company is the investor into the VCC, okay? So we provide the fund administration for the entire fund, and you can have different share asset classes, A, B, C, D. You can even invest it into Indonesian companies. You can invest into Hong Kong companies, and you can invest into US companies. There's a lot of ways to actually structure this, okay? And again, the main thing is sometimes you can also set up a sub-advisor to the fund manager in order if you're gonna be charging a fee or something like that. We're seeing great interest in this primarily because it's a Singapore fund, not subject to tax, but you do need to set it up in a very particular way. Unlike Cayman, it's just super easy. This one you need to apply for and obtain the tax exemptions, okay? Again, I won't go into this. This is obviously stuff that we do. We do the fund accounting, we do the investor reporting, we do all the VCC setup. We provide the secretary, we issue the shares. So when clients need this, we provide the end-to-end service on this, okay? And that's it on my side. I just try to touch on those 3 or 4 main issues to consider, okay? Feel free to contact me if you have any questions. I'm gonna stop my share screen now.
Thank you, Frank, for your insightful presentations. Just a quick sum up from Frank. I think as foreign buyers of property into the US, we have a few options. We can go for foreign blockers, or we can set up trusts. And there's a lot of options that Frank has touched upon, in particular, how to set up a family trust, and then the 13X and 13R are family offices, which also at the end of the day can also turn into the single office, family office, which at the end of the day will help you structure with no income tax. Plus the other options of VCC, which essentially take away the Cayman family into Singapore. So a lot of options, which very, very insightful. I hope there will be a lot more questions coming up later on in this particular things. And one of the key drivers of that too, because of the end of the tax amnesty for Indonesia, there are a lot of drivers of people knowing that right now. So again, insightful, Frank, appreciate that. Before we move on to Richard, we need to take a quick poll. Please check your screen for the second poll that we're gonna need your help to, yes, okay. So the poll is, as a foreign investor, can you see the screen now? As a foreign investor, do you feel confident that you can efficiently structure your US resident asset to minimize taxations? Please go ahead. Thank you. Now, the next speaker will be Richard Jordan. Richard is the head of global markets for Douglas Elliman. Again, he will be sharing a lot of perspectives based on market and commercials. So Richard, hand it to you now. Thank you.
Thank you very much, and good morning, everybody. Obviously, I'd want to start by just simply saying that these are uncertain times, and that we're all experiencing around the world today. We're inundated with a lot of news in our own markets and in other markets. So what I would like to do today, and also my colleague Andrew Wachtfogel, is to provide greater detail and some clarity on the U.S. markets, and more specifically our key cities where we're seeing the highest level of foreign purchasers in the United States, which is New York and also Los Angeles. But before I go further and discuss where we are today, I do want to take a moment to step back and reflect on where the United States was just 6 months ago at the beginning of the year. The US was experiencing a very robust economy. It was the #1 economy in the world. We had a 50-year low unemployment rate at 3.5%. Equity markets were very strong. We were breaking records on a consistent basis between the S&P 500, the Dow Jones, and so forth. Obviously, as the pandemic grew, we experienced, or the US government had to respond quite quickly. And of course, we passed what was called the CARES Act. And the CARES Act was the largest stimulus package in US history. It was also the quickest the US has ever responded for stimulus. And that was passed on March 27th of this year, obviously. And that was a total of $2.3 trillion, which helped to backstop the US economy and helped to slow the increase in unemployment numbers, and also the stock market, where we saw that decline by about 40%. But what we're seeing now is very positive indicators of recovery in the US, which is why the US continues to be, among the top safe haven destinations around the world for a wide variety of reasons. But if we take a look at where the stock market is today, we are now back in just a short period of time over this 3 months, back to Q1 2020 levels. And in fact, the NASDAQ 100 reached all-time highs in June, and then it reached all-time highs again just 4 days ago on July 6th. Now, obviously, this is due to the level of liquidity that's been placed into the market, but it also is an indicator of investor confidence and our ability to sort of navigate this period of time and look beyond and overall recovery in the United States. So now, with that, another positive indicator is the recent jobs report that just came out a few days ago. And we added 4.8 million jobs in the month of June. We also added about 2.7 million jobs in May. So between May and June, we had 7.5 million jobs added. Of course, we still have a ways to go to get back to this 50-year historic low unemployment rate, but we are seeing positive signs of recovery. We're making big steps very quickly, and we expect the US to continue to go down that path based on where we're seeing the equity markets go, where consumer confidence is going, and as the markets start to open back up throughout the United States. Now, all of this is occurring in a low interest rate environment. And as I mentioned, there was a significant recovery in the equity markets, and either as an investor, maybe you did buy into that market, into that recovery, or maybe you missed that recovery. But what we've seen since that V-shaped recovery in the equity markets is a lot of our high net worth clients are realizing there's more volatility there at the levels we're at currently. And so they're starting to shift to other asset classes. And one of those are is obviously residential real estate. So, during these volatile times, ultra high net worth individuals are seeking proven markets that offer transparency, low barriers to entry, and of course, the history of long-term stability. But I think that the signs of recovery that you're seeing here thus far are indicators of the stability that the US can provide. And that is why we are seeing an uptick in interest from foreigners as we begin to build upon the positive momentum that we've experienced over the past few weeks. It's also important to note that the New York market, which Andrew will talk about briefly, the New York market had been closed for about a 3-month period and just opened about 2 weeks ago. So he's going to give you some statistics there, but also just give you a more pulled back macro look at why New York and also LA are these destinations of choice for individuals seeking safe haven status and also the ability to recover. But when I mentioned low barriers to entry, if we look at select key markets around the world where foreigners typically choose to invest, many of these markets are imposing significant foreign buyer stamp duty taxes. So if we look at the UK at 1.5 million pounds, you're at 15% stamp duty tax. At Canada, you're at 22%. In Singapore, you can be 20 to 22%, and in Hong Kong, 30%. So the great thing about the US, and Frank mentioned this earlier in the presentation, is the US does not impose a foreign buyer stamp duty tax. And so foreigners are actually treated just like domestic purchasers on the entry. Slight variances on the back end, which Frank mentioned on the capital gains, but still minimal. And through the right structuring that Frank has mentioned, it's a great way to be investing into the US market through these various entities and structures. So with that, what I would like to do is introduce my colleague, Andrew Wachtfogel, the head of research, to give you guys a macro view on both New York and LA and why we're seeing an increase in these markets from abroad. Thank you very much.
Thank you, Richard. Good morning to everyone. It's a pleasure to be with you virtually. As Richard said, I'm going to cover some mostly long-term statistics to help us all understand that even in times of uncertainty, the long-term view is typically the best, especially when trying to understand investment and returns on those investments. So continuing Richard's discussion of overall healthy indicators pre-COVID, I'll note that both New York and Los Angeles markets were in a really good place at the beginning of this year. After a period in which pricing admittedly got a bit frothy in New York and inventory built up, pricing readjusted to a point agreeable to buyers and sellers, and this led to an increase in sales activity, which began to eat away at that inventory at the beginning of this year, the end of last year. In fact, Manhattan closed sales in the fourth quarter of 2019 and the first quarter of 2020 were up 10% year over year, which was on a good trajectory, while prices had pulled back about 10% from the high point in 2016. So dial back in prices was good for the market. As a result, as I said, we had strong market fundamentals heading into March of this year. And so to help us understand how to examine the market looking forward, let's take a look at the long-term performance, as I said, of the Manhattan market. And Georgina, if you could just go back one slide to the sales. Right, thank you. So as you'll see on here, over the last 30 years, as we all know, we've had three notable market interruptions. And as you'll see in this chart, the dips were relatively short, while the recoveries were significant. On the far left, you'll see some the sales totals here after the 1990 and 1991 recession in the US. Sales dipped in 1992, but then more than doubled by 1993, starting on a 10-year growth period. Then fast forwarding, we see a minor dip in sales during 2001 due to September 11th, but sales rebounded by 2002, which led to an exponential sales growth in the mid-2000s. The global 2008 financial crisis impacted sales in 2009 only, but sales recovered by 2010, kicking off another 8-year expansion similar to what happened in the prior decade. So while sales have been understandably impacted this year in 2020 by various factors, it's important to note that, as Richard mentioned, it's not necessarily a result of the decrease in demand in our market, but New York City was under a 90-day shutdown of in-person showings, which was mandated by the state of New York. And so none of these previous market interruptions we had in the past had this mandate. And I think in most markets, but particularly in the US market, buyers don't want to make that a final step to a purchase unless they can actually see the apartment. So even though transactions technically could move forward, the shutdown of showing property essentially shut the market down. This was the most stringent shutdown in the entire United States. But it did enable us to get past COVID and end the shutdown by June 22nd, which was just a few weeks ago. So it was effective. I will note that in our New York portfolio, since that June 22nd mandate was lifted and we could show property again, we've actually had more offers on our New York portfolio than in the entire month prior. So the last 2.5 weeks, more offers in the entire month prior. So that shows you that that demand didn't go away. It just was sort of held off by the lack in showings. So let's take a look at pricing now. This is the same 30-year chart, price history for New York City. So where you'll again see that through these three significant market interruptions over the last 30 years, prices remained either level or quickly recovered. So following both the 1991 recession and the September 11th, there was no real significant price drop, as you'll see on here, but these prices remained flat instead. In between, though, prices increased 188% from 1992 to 2001. So a substantial jump between those two periods. So by 2008, prices had increased an additional 81% from 2001. So quite a difference over those 2 decades there. And then following the global financial crisis, the average price dropped just 9% in 2009, relatively low figure when you take into account the increases over the prior 20-year period. But then further going into the future, this was followed by a 57% increase in prices by 2016. So as you'll see, as I mentioned, either no price changes or minor price changes during times of strife in the city, and then afterwards some pretty significant price gains as demand returned to the city. So looking to where we are now, and a positive sign for the market, prices have gradually decreased about 10% over the past 4 years. But that helped increase sales demand, as we talked about, as buyers have been tempted to enter the market. So in summary, on those prior 2 slides, New York market has historically seen relatively quick pricing recovery, as I said, following market interruptions, and then sustained significant price growth and afterwards. So now let's quickly review the pipeline of future new construction deliveries so we understand what's happening as we move forward. As you'll see here, this is showing total number of new unit deliveries each year going back to 2009. And there were more than 20,000 new build units delivered in Manhattan over the past 11 years. But the vast majority of these that launched over those 11 years have now sold through. So that's sold through inventory. The heaviest year for new build was 2015 here, which you can see more than 4,400 units enter the market. But I want to put this total, which is the highest on this chart here, in perspective. There are more than 850,000 existing apartments in Manhattan. So even that high point in deliveries over the last 11 years of 4,400 units was really just a drop in the bucket to that 850,000 apartments. So in New York City, unlike other global cities, when we have big years of delivery, it really doesn't impact overall the total supply of apartments in the city. And looking at last year here in 2019, there were less than 2,000 units entered the market last year. That was the second lowest total of the last 7 years. And so most importantly here, if you see on the right in the red, there are only about 3,000 new units financed and under construction in New York City right now, which will probably encompass the entirety of the units launched over the next several years. So this signals a potential drop in new units delivered in coming years compared to the last few years, which tells us that, again, as we think about that overall number in Manhattan, that the supply issues in the city really aren't too much to worry about. So let's now move to a review of the Los Angeles market. So similar to New York, Los Angeles was on a good trajectory at the beginning of this year. Average price had been steadily rising for 7 quarters, and condo and single-family home sales had increased at the end of 2019 through early 20. So as you'll see here, this is a 15-year history of sales in Los Angeles, and we have 2 different colors on this chart. Single-family homes are a more significant part of the Los Angeles market, but condos still claim nearly half of all sales there each year, so it's a significant part of the market. And if you look over this 15-year period, sales totals have grown quite significantly and quite steadily over the last 15 years. So again, if we look back at the 2008 financial crisis, we see that sales were only impacted in 2008 and actually, in fact, increased 34% by 2009, which is a pretty significant jump after that. Then sales increased nearly every year until 2015, at which point they were nearly 3 times higher than in 2008. So that's pretty significant post-crisis sales growth. With the dip in sales last year, as you'll see on here, combined with a likely decrease this year, 2020 may be an opportunity to enter the market that's a bit cooler than we've seen in the last couple of years, which typically means some opportunity. So finally here, let's take a look at pricing in LA. Again, we've got a 15-year chart to see the history, and looking at the long term, you'll see that the average close price in Los Angeles has increased about 140% over the last 15 years. In this time frame, we see average price dropped in 2009 in the midst of the financial crisis, but it had increased by 2010, and then by the time we reached 2016, it had more than doubled. In fact, if you look deeper into those numbers, we see that prices had already actually started to increase by the second quarter of 2009. So that showed just a 6-month time frame for that turnaround during the financial crisis when prices kind of bottomed out for that period. So in summary, in the New York and Los Angeles market, as we've seen from these long-term trends, through various market cycles over time, and there has been significant appreciation realized throughout these time periods. And this is why we know these two cities continue to be attractive for investment, both domestically and internationally. And in fact, especially in challenging times, as something of a safe haven, both for domestic and international investors. So with that, I'll hand it back as we move on.
Thank you very much, Andrew and Richard. That was a really interesting insights. Pak John, I don't know if you wanted to touch on any key points raised from Richard and Andrew before we move on to the panel discussion.
I think just a few points. I think both New York and LA consistently has shown an increasing trend of pricing, despite the fact there was some crisis in between the decades, right? So from that, it's pretty show a strong pricing pricing increasing. At the same time, you look at the past few years, the supply demand, it seems that the supply pipeline is less, which is also a good indication that the pricing will further going up if you look at the supply point of view. So I think from my perspective, I think the insight for me is the both market continue to be strong in terms of the demand and also the pricing. That's what I can sum up from that.
Thank you very much, Pak John. And I think with that, if you agree, we will open the panel discussion and have one final poll before we do that. So another poll question should pop up onto your screen just now. So as a foreign investor, do you feel, it's popped off?
That's, yeah.
Okay, which prime residential markets are you most interested in? So New York, LA, Miami, or other? You can answer 2 or even 3. Thank you very much. And with that, Pak John, let's open the panel discussion.
Okay.
And I will hand over to you.
Okay. I think I relate a bit more into most of the parents here in this forum, whereby we have children studying in the States right now. As we speak, my daughter is in New York City studying the 3rd year in college down there. So I think a lot of questions that I have in mind may relate into that perspective in terms of how are we going to take advantage of investing into property while our children are studying there, and some of the questions that come up, truly I can relate to that. So the first question that sent to us, which I will ask, I think, to Frank for now, is this is a good question. I'm a 65 years old man. My kids are both working in New York City. I want to buy a property in New York City because I go there for work and give my kids a place to stay, but do not want my kids to own it. How should I own the condo, and what's the estate duty if something happens to me? And how do I make sure the property goes to my family? That's the questions that I would first ask Frank, I think. If you can
Sure.
take that.
Thank you, Pak John. This is probably the most common question that we get, okay? Which is that, my kids are studying there, or my kids are working in New York or Los Angeles or Boston, but I want to buy a very nice, safe place, but I don't want to give them the house, right? Because I want them to work for it. So the best way to structure, I alluded to the slides, is really to put it under a foreign blocker company that then owns a US LLC company that then owns the property. What's the main advantage again? You're not trying to subject yourself as an older foreign person, okay, to basically US estate duty in the event something should happen to you. But at the same time, you can set up a trust, you can own that outside, and then essentially in the event something happens to you, that particular asset can go directly to your kids under the trust. You're never subject to any transfer taxes because The structure is not selling it. The structure remains intact. And then essentially you just own that particular asset indefinitely. All right. This is really good for clients who just want to own it, okay, for the long term, for their kids. They don't see themselves selling it. It's just a place to stay when the family gets back together in New York City, et cetera. But what it does, it doesn't give them the asset right away. It forces them to work for it. They're just staying there. Okay.
Thank you.
Thank you.
The next question, I hand it over to Georgina first.
Thank you, Pak John. And I think, Richard, this is probably one for you. In respect of both New York and LA, in light of the current climate, are you seeing developers take discount in the market? And if so, at what price point?
Yeah, look, I think it's a bit early, as Andrew's mentioned before. You know, we had a 90-day shutdown in New York. But what is interesting is that of the deals that have taken place, we've seen that values are actually holding quite strong. You know, a couple of other indicators, for example, online traffic in New York City during the COVID period actually had returned back to May 2019 levels. And so what we're seeing is there is a lot of interest. Now that our sales galleries are open, agents are able to do appointments, we are seeing more transactions take place. And we had quite a few very successful prominent transactions occur in both New York and LA within our portfolio during the shutdown period. But again, we're seeing great demand now. That said, you know, developers are obviously making some deals, but value is holding strong. But what we're mostly seeing is that developers are offering a percentage of closing cost credits on the back end. And then as a whole, we would say about 6% off of the ask price seems to be the average. There's always, you know, a couple outliers here or there, but right now we're seeing at about a 6% discount off of ask. And this just goes to show and to prove our point that it's New York's resiliency, LA's resiliency is why people invest in these markets, because their ability to hold value. And as Andrew indicated before through these historical charts, is how quickly they recover. And so, you know, value seems to hold quite well through all of these times, as Andrew has shown us.
Thank you, Richard. Pak John, I don't know if I want to have another question for Frank.
Yeah, I think so. I think this is again back to again put it my. I mean, I can relate again. A lot of parents, I think, also relate to this. Going back to the first point that I just asked just now, Frank. Now, if later on, you know, you decide that property will be going to your children, would that have implication to the inheritance tax on that? If you set it up like you have mentioned earlier on through the trust or through the family office, would that still have implications of inheritance tax?
Okay, that's a good question. So essentially, I'm only talking from the U.S. perspective, right? But basically, what would happen is that the LLC and the foreign blocker corporation, like the Hong Kong company, you would fill out what's called a quitclaim deed, okay? And you would just transfer it to the kids' names, all right? And there is no inheritance tax. There's no estate duty tax or anything like that on that particular transfer over to them as non-U.S. persons, okay, as non-U.S. persons, okay? So if they plan on studying there, you know, and they want to get a loan or something like that, what happens is you do a quitclaim deed back into their name, and then they should borrow money against that particular property. Once it goes into that, but once they go ahead and they're working there, et cetera, then they become U.S. persons if they're working there over the long term. And if they want to become immigrant, instead of basically being under a non-immigrant visa, they do what's called an adjustment to an immigrant visa, which is like an EB-5 or a green card or something. And then they can get local loans. And then the whole objective is that they're taking advantage of the tax exemption of $5.25 million as a U.S. person. Okay. So I mean, you know, I think if you have clients in these particular situations, it's easy to transfer the asset out to the kids. We need to probably take a look at what point you want to transfer, if they're still a non-U.S. person as a student, for example, or you want to wait until they're at near the end where they really have decided, you know what, I'm going to become a U.S. person. It's okay. I'm just going to stay here. I'm going to work here. Because once that happens, there's a lot of family planning issues. On the other side, if the dad has a lot of, you know, trusts or bank accounts outside, because once the child becomes a U.S. person, and you want to do private banking planning in Singapore, you will probably have to take him out on some things.
So that means regardless of a U.S. person or non-U.S. person, if you structure it in a way with family office or what have you, that means inherent tax is irrelevant anyway.
Correct. Yeah, that's exactly right. Because the idea is once you, again, if from a non-U.S. person perspective, okay, once you have it in a structure, the structure doesn't die. So there's no estate duty issues whether you're a U.S. person or a non-U.S. person once it's under a structure.
Okay. I think that may answer most of the questions in mind of people right now. And while we're on this, another question, which is again very, very interesting, again relates to parents. There's a question just like this. My son is studying in the U.S. now and returned to Indonesia to work in a family business after finished school. I have a Singapore fund, a trust, sorry. Can I leave my son on my Singapore trust as beneficiary because I'm worried it will create a U.S. tax issue?
Yeah, that's a common question we get also. Again, if they're in the United States under an F1, okay, or an H-1B visa, which allows them to work for 1 to 3 years after they graduate from a U.S. university, they are not considered U.S. persons during the entire duration of under the F1 through the entire duration of the H-1B visa. Okay, so they don't have to worry about taking the son off because the son is trying to get training in the United States, et cetera. They don't have to worry about taking them off of their Singapore trust or anything, any discretionary trust sitting outside, okay? The main consideration you have to take in mind is when the son decides, you know what, I'm gonna do an adjustment from an H-1B to an immigrant visa, okay? Then a lot of other matters come into play, like the substantial presence test, okay? As well as if they're going there under an L visa or something that would cause them to become a US person and meet the substantial presence test, but not under an F1 or an H-1B. Okay.
So in this particular case, that means if the son is coming back to Indonesia and work for the family business, nothing to worry about, right?
Nothing to worry about.
Okay, I think. Back to Georgina now. Thank you, Frank.
Thank you very much, both. This is probably one, Richard, for you. We've had quite a few questions come up in the live Q&A and sent to us previously around the rental market in New York. If you're looking to rent your apartment out, what's the process, and can you provide further insight into that?
Sure. I mean, obviously now we're coming out of the shutdown period, but the process is pretty straightforward. Keep in mind also in New York City, prior to this period that we're undergoing, the vacancy rates in New York were incredibly low, 1.8% for Manhattan, and so if you want to rent out your unit, should you purchase, obviously then you would work with someone at Douglas Elliman locally. We will then list your apartment out publicly as soon as you take ownership, and then we show it out to tenants. And we can also, we have one of the largest property management teams in New York City, so we can handle the property management for you. We can handle the rental, and then we will show the apartment, put the renter in, and help to sort of manage your property on the day-to-day. And we are seeing that rentals still are moving as the market has opened up again now. 2 weeks ago, transactions are starting to pick up again, but we need to get further past this period of time.
Thank you. And can you provide any comment as to the most popular unit type from an investor perspective? And I don't know, Andrew, if this you also want to chip in on this, but specifically a 1-bed, 2-bed. What do you recommend from an investor standpoint?
Well, I guess I'll let Andrew touch on this as well. But for right now, there's 2 different options. Obviously, there's always demand for 1-bedrooms and smaller 2-bedrooms. And we see a lot of parents that are buying on behalf of their children are typically buying 1-bedroom residences, and those are easy to rent. But there are great pockets of opportunity purely for investment today in larger residences. And so I think that it's, we need to be specific about what neighborhoods, which buildings, and your real estate agent will be able to sort of guide you through that path. So we could certainly do that. But I would say either stay the 1-bedroom or go more in a super prime level based on what we're seeing in the market today. Andrew?
Yeah, I would echo that, Richard. So just some stats, and one bedrooms are the most rented type. So in fact, in June, one bedrooms made up 42% of all new leases in Manhattan. The second was two bedrooms that made up 25%. So if you're going straight from a standpoint of just kind of buying what is the most frequently rented unit type, and of course those are more bite-sized prices. But I will back up and echo what Richard is saying. Is it comes down to kind of what's your investment plan and how much money are you spending. And there is an opportunity at this point in the market, I think, to buy some larger apartments that may have some good pricing attached to them. And New York City, because of the type of a city that it is, and that basically across all income strata people rent. People will rent 3-4 bedroom apartments for significant sums of money. So there are, I think, some potential opportunities to be had, and renting is always kind of a strong aspect in the city. So it's a good question to kind of look into, depending on what your budget and your investment plan.
Great, thank you very much both. Pak John, I'll hand back to you for the next question.
Okay, thanks, Georgina. The next question is again back to you, Frank. Very popular amongst parents. There's a question. My daughter is going to study at Columbia next year. I want to buy a small property for her. Can she open up a bank account in the US? And can I transfer the money to her to buy the property in her name and subject to global income tax?
Okay, that's another really good question that we get a lot. Okay, basically a non-US person, parent, giving the money basically even to a US person. Okay, there is no tax implication whatsoever. In this case, she's a Columbia student. She's still a non-US person. She can go ahead and open the bank account. She can receive the money, and there is no tax implication whatsoever. Once you receive more than $150,000 US, you do need to do a declaration, okay? But you actually are not subject to any income tax on that. So the daughter can literally take $200,000, $500,000 that's sent from the parent, and then she can go ahead and put that as the initial down payment for the house, okay, in New York in her personal name. She's still a non-US person, but the thing is she can borrow money in the United States, and that doesn't count on the exemption. I mean, so her total equity in the house is only $500,000, right? So say she buys a $3 million or $2 million condo in New York City, that $1.5 million may be in the form of a loan, all right? Mm-hmm. But her equity is only $500,000, which means she has an estate duty exemption of $60,000. So obviously she's quite young, so chances are nothing will happen. So that's a very common way to own it, because her estate duty would only be subject to about half of $440,000.
But all other local tax will apply, right? Like
all the other
tax.
All the other normal taxes will apply. She will also have to pay a higher foreign capital gains tax, okay, which would be essentially 30% as opposed to a local person at 22%. But then all the property taxes would apply, whether it's under a structure or under a personal name.
Okay, I think that's a common question amongst the parents too, because a lot of the parents are thinking now, for those going to New York City in particular, renting an apartment or staying in a dormitory is not cheap anyway. So this is a good option for them to look into. Buy the property while you can invest at the same time. Your daughter or son can use it, and then once they graduate, they can still continue to be rented out and also enjoy the capital gain one day want to sell it, right? So I think that's pretty relevant. Thank you, Frank.
You're welcome. Yeah. I just want to add that a lot of times what we see is the parents also want a place to go to and be with the kids. That seems to be a very common recurring theme. They actually want a place big enough so that they can actually go, when they visit their kids, they can actually stay in one of the rooms.
Yeah. Tell me about it. I'm going to New York City like twice a year now.
Yeah.
For crying out loud.
Yeah, exactly.
Thank you, Frank. Back to you, Georgina.
Thank you, Pak John. Okay, one that's come through our chat box. So Andrew, I'm going to ask this to you. With safe distancing applied past COVID, is this expected to be the new normal? What will the future demand of high-rise apartments located in highly populated density areas be going forward?
Yeah, that's a good question. You know, New York City and the United States had never really experienced this kind of a situation before. But I'll say as a New York resident that what I've seen and what we've started to put into place is pretty impressive. So the city has transferred very quickly, both from a public health standpoint and from a private ownership standpoint, to address this quite well. So the city has instituted some pretty heavy cleaning procedures when it comes to public transportation and to public spaces overall. So from a city standpoint, it's really been solid there. And from an individual building standpoint, building owners in New York, whether it's a rental building or whether it's a condo building that's managed by the condo board and by local property management companies, have snapped very quickly to try to figure out best practices for this. So along with state guidance and National Centers for Disease Control guidance on best practices, actually not even almost, every single building in New York City, whether it's a residential building or an office building, has quickly instituted processes to make sure that people are safe. And you know, all of these condo buildings that we represent are highly staffed with highly qualified staff at the front door and live-in superintendents who are constantly monitoring the building. And the buildings themselves are managed by property management firms that are some of the top, they're the top in the city, and they manage thousands of buildings altogether. And so they've quickly instituted these. So everyone that I know that lives in these buildings in New York has said they feel actually most comfortable in their building and feel really no risk at all. And so I think the ability for New York to adjust quickly to this actually puts confidence in someone investing in a place like this, because something that basically our city and our country never dealt with up 3 months ago, we've instituted basically long-term ways to address this and make everyone feel safe. So I think that's something that people shouldn't really be worried about, and actually should make them more confident in investing in a city like that.
Thank you very much, Andrew. And one other question to both of you, probably. Richard, I'll start with you though. You talk about opportunity in the market. How long do you think this period of opportunity will last? And also, how do you see this playing into overall market sentiment with the presidential election coming up? Can you provide comment on that?
Yeah, I mean, obviously we can't predict the future, but what we can and what we do know is through Andrew's charts, we see that these windows of very narrow. And again, this is why we see a lot of individuals coming and investing in places like in New York and LA for safety. But I would say that the best time, certainly this is the best time to be buying in New York since the global financial crisis. And we saw New York City begin to recover in just 5 quarters. One other thing we have to think about is when a vaccine comes, and we're well along the process of clinical trials for the vaccine. So whether that's in Q1 of next year, Q2, even Q3 of next year, that's significantly going to change the mindset of everybody, even really around the world. And what we have also seen is that if you go back to September 11th or the global financial crisis, we're reading news all the time that sometimes there's misinformation, but every time we had a major crisis like this, they would typically say that maybe New York's not going to pull out of this, and every single time New York has recovered and come back stronger. And so that's what that 40-year chart shows. We expect that not to be any different for this recovery, especially given the signs that we're starting to see in the market today. So, but that window that I would recommend, and I'd love Andrew's thoughts too, would be now until the end of the year, and probably even more so between now and the election, because there'll be more stability after the election, just because that's one more thing or one more certainty over in the U.S. economy. So, Andrew.
Yeah, I agree with that. And actually do want to point out one thing is that the New York market in particular started to correct itself as we saw in some of those charts actually late last year. So from a pricing standpoint and from a sales standpoint. So it's not like we just started, a month ago to kind of deal with the current issues with COVID. So since the market already was in that correction period and we saw demand increase because of that in the beginning of the year. So that's one thing to think about. Now, combined with what Richard said is typically presidential election years in the United States are always slow sales years as you move in basically to spring through the election in November. So that's obviously being compounded by what we're dealing with right now. But if you kind of factor that in with the correction already starting last year, and now we add in COVID, at this point in July, we're kind of dealing with the maximum amount of kind of things piling on. And typically in the history of New York real estate, the time that really was the time to invest was during that time period. And without sounding too much like a salesperson, you don't know when kind of the quote unquote bottom of the market is or the good time of the market on pricing was until you've already passed it. And so, when you're kind of in the midst of it, dealing with the most amount of challenges, which is typically where we are, which is certainly where we are right now, seems to be that place. I would think that as soon as the election's over in November, if you judge by what happened in 2016, where we had a sales jump immediately after the election in November through the first and second quarters of the following year, I think we're going to start to see an increase in sales, actually probably in the fall, but then again after the election, and then as we move into 21. With the vaccine on the table, then I think even more so things are going to start to turn around. So, it's really the next probably 3 to 6 months that's a key time period.
Thank you very much, Richard and Andrew. And Andrew, just one other question I wanted to ask you. A few questions have come into the chat box in respect of LA. Do you have any recommendations as to specific areas or locations in LA that are better, say, for an investor to be considering?
Yeah, so LA is interesting. It's my hometown actually, even though I live in New York. So it's changed a lot over the last 25 to 30 years. These statistics we saw encompass the core parts of LA, which run from downtown Los Angeles, where there are all the tall condo towers, most of which have been built in the last 10 years or so, stretching through kind of the core part of Beverly Hills, West Hollywood, and then to the west side of LA along the coast. So really the super prime market of LA from a condo standpoint is Beverly Hills and West Hollywood. The interesting thing about that zone of Los Angeles is there's some very high level projects being built, but from a total overall inventory standpoint, it's not a lot of buildings. There are maybe 4 or 5 buildings that have 20 to 40 units each total. And so we're talking about the opportunity in LA for prime product is only a couple hundred units maximum. So comparing that to other cities where there's thousands of units. And then in downtown, which is where all the high rises are, that area has changed to be completely a residential and an office center. And so that's kind of a key area investment as well. The prices there are a bit lower. But I think looking at where the real opportunity is, because of the lack of product and because of it's a kind of a core, what we would say blue chip neighborhood, it's the Beverly Hills, West Hollywood area. So for example, the condo buildings that we're selling there are within a mile or two of, some of the biggest properties in LA, 20 to 30 to $100 million estates, single family homes estates. So you have the opportunity to buy condominiums in some really well-designed buildings right in that core zone. And there are actually not a lot of development sites that exist to build condos in that area. So it's kind of a rare occurrence. That's kind of really where the opportunity for investment is going forward, I think, in LA.
Thank you very much. And Andrew, sorry, I don't know if this is one for either you or Richard, but I'm looking to buy, if I'm looking to buy, hold, and then sell my asset in the US as a short-term investment, how would this process work? Can you give any further insight into that?
Yeah, sure. I mean, I'll start, Andrew. But I think that I don't look at real estate ever as a short-term investment. That would be my first answer, and especially not today. And John Jacob Astor said, if there's anything that he could have done more of his entire life was that he would have bought more real estate on the island of Manhattan. But right now, as Andrew has mentioned, is we believe this is the best window, certainly since the global financial crisis, to be investing in one of these markets. But so first, you work with us to help you find the right property based within your budget. I would say that you should expect to have at least a 3-year hold period. My recommendation would be 5, and then if you don't have to sell, don't sell. But as soon as you purchase the residence, we'll rent it out for you. Again, the rental market historically in Manhattan has been incredibly strong. We're starting to pick back up now on the rentals now that we've been able to open the market. But prior to COVID, we were at about 1.8% vacancy rates for Manhattan. And so that's what we would do. We would, first make sure you're buying at the right price and the right buildings with the right developer, the right level of services. And then we would lease out your unit and then hold it for, a 3 to 5 year period. Typically the leases in New York City and also in Los Angeles are a minimum of 12 months. Some buildings are a little bit less, but for the most part, prime buildings, you have a 12-month minimum. And then if you're looking at larger residences, oftentimes those clients will have a 2-year lease term, in some cases a 3-year lease term. So, but that's all negotiated during the rental period. And as your agent will help you do that. And then when the market's right, it would be a great time to sell. And again, I think it's the perfect window of opportunity. And, just to mention some things Andrew was saying about LA, just in the past 3 weeks, we have done significant transactions in a building called the West Hollywood Edition. And, there's very limited inventory there in that market. And so again, we're starting to see this demand come back. In New York, we just did major transactions on 111 West 57th Street, 2 very large purchases, one of which was from, the buyers was from Asia. And we've also seen it in the Waldorf Astoria. So
great. Thank you very much, Richard. And before we wrap up, I'm going to ask each of you, Frank, Richard, and Andrew, what is your one key consideration for any investor to succeed in today's market? Frank, I'll go to you.
Okay, thanks, Georgina. It's probably, what I've been saying, you probably somewhere about $1 million or above, you should at least consider and look at possibly putting it under a structure if you're investing as a non-US person. Okay, and it's just consider it. You have to at least look at it, I think. Thank you, Georgina.
Thanks, Frank. Andrew.
Yeah, I'd say I would recommend when looking at a place to invest, if you're kind of judging overall, is look at the key fundamentals of what drive the local economy, especially when you're looking at a time now where we obviously are dealing with challenges globally and locally. So if you look at LA and New York in particular, the key local professions that have driven the economy for a while and will into the future are finance, law, medicine, and tech. And so those are 4 professions, if you think about it, that are still strong now and will be strong, maybe even stronger into the future, and they will prop up and drive the local economy. So in deciding, what your consideration is where to put your money, is understanding that those are always going to be the key parts that drive the economy and that prop up your asset as you move forward.
And finally, thank you, Andrew. Richard, over to you.
Yeah, we've been getting this question quite often, and I like my biggest piece of advice in today's times would be to have patience and take a step back and have a long-term view. Again, there's quite a bit of uncertainty for all of us in each of these markets, but as Andrew's indicated, New York's resiliency and also Los Angeles's resiliency. So if you take a step back and take a look at seeing beyond this current period and in recovery, I think just having the patience to do that, and obviously, of course, buying in the right buildings in the right neighborhood, but then also just have the ability to execute. Don't be afraid, make a decision, execute, and then be patient on the hold. 3 to 5 year minimum. If you're sending your children to school, that's a great time period over the 4 years for your son or your daughter to be in the apartment and rent it out to their roommates. Or again, we'll find a tenant for you. But that's what I would recommend, is have a long-term view, have patience, and then work with Douglas Elliman locally in the United States and listen to your agents, because there are some incredible opportunities right now.
Thank you very much, Richard. Pak John, I'll hand back to you.
So I think, thank you, Georgina. I think from a time perspective, we are pretty much towards the end of our talk right now, right? I see a number of questions which we may have answered and we may not have answered. I think we shall look at it later on and send perhaps a follow-up email, perhaps, Georgina, to follow through. I think again, I thank you all the panelists. I take it from a parent's perspective, this is very useful. I am pretty sure a lot of parents within the forum can share the same sentiment with me. Other than that, I think if we have not answered all the questions for you, we shall follow up later on through emails and other things. And in case there's lot more interest for us to do another follow-up webinar like this, we are more than happy to also consider that, I think. So with that, are we pretty much towards the end, right, Georgina?
Yes, we are. Yeah.
Please.
So just touching on that, if anybody has any questions for us, please do feel free to send them through. I know we've got a lot of questions that have come through the Q&A box, which I'm conscious we haven't had time to answer all of them. So please do reach out and we will answer those, within the next 24, 48 hours and come back to you on those points.
Okay, with that said, on behalf of Indo Buckeyes, and on behalf of Knight Frank and Douglas Elliman, I want to thank everyone who joined us today. I hope this is a good sharing information that you can take into consideration in making your decision. Thank you all and have a good weekend.
Thank you, everyone.
Thank you, everybody.
Thank you.